I'm pleased to be speaking to another strong set of results for 2017, building on the positive momentum that we put in place in 2016. Revenue was $5.8 billion, benefiting from continued growth in consumer demand and also a recovery in Element 6's oil and gas markets, as well as, obviously, full consolidation of De Beers Jewelers following our acquisition. From an EBITDA perspective, EBITDA was $1.44 billion, up 2% from the prior year, despite the lower revenues and despite the stronger rand, which impacted our cost base. That was largely down to an improved cash cost performance in the production side of our business, but also reflected the fact that we had spent more in investing in our core business. So, for example, our marketing expenditure was up to $140 million, up $20 million, and we've invested in market development, including our blockchain initiative. So production in 2017 was 33.5 million carats, up 22% from 2016's 27.3 million carats, driven in large part by the commissioning and ramp up of the Gaucho Quay mine in Canada, as well as an additional 2 million carats out of Orapa. Within Debswana and indeed the Orapa regime, we're also currently bringing Damsha out of care and maintenance, as well as ramping up the Lethalikani retreatment tailings plant. In addition, in 2017, we saw higher mining rates from the Mafuta crawler vessel as part of the Deb Marine fleet, and across Victor, GK and Venetia, we saw higher grades, but also, importantly, improved plant performances. I do want to take this opportunity just to recognise our colleagues at both Victor and Vorsput, where we've announced closure and sale respectively. These are both assets that have performed well above expectations whilst they've been part of the portfolio, and we wish our colleagues the best going forward. I'd also like to commend them on the strong safety performance that they've had, particularly in the last few years, with Victor winning 2 Canadian Safety Mining Awards. Going forward, our production guidance is 34 to 36 million carats. In 2017, we spent over $270 million investing in our core business. Chief amongst those projects was the continuing development of the Venetia underground mine, which is due to start production in 2021. CAPEX was lower than in 2016, principally because we've now delivered and commissioned the GK mine in Canada, as well as the SS Nyoma as part of the Deb Marine fleet in Namibia, and of course we've started mining ore from Cut 8 at Jwaneng. Going forward, our focus is very much on sustaining production from our assets in Debswana, so thinking about the next cut at both Jwaneng and Orapa, as well as thinking through the ability to add to our marine fleet in Namibia. Also during 2017, Element 6 invested over €7 million in its plant at Shannon in Ireland, and that's particularly significant in that it created 100 jobs in the area, taking the total complement up to 500. In 2017, sales were 35 million carats, up from 32 million carats in 2016. The increase in volume is largely accounted for as a result of the impact of demonetization in India in the fourth quarter of 2016. Lower value goods were deferred from 16 into 17 by a number of our customers because in India, cutters and polishers of those lower value goods were more significantly impacted by demonetization. In terms of average realized price per carat, in 2017 we saw that at $162 per carat, down around 13% versus the prior year, despite the rough price index being up 3%. Again, the stones that were deferred from 16 into 17, the lower value goods, account in part for that change in average realized price. But in addition, volumes which were ramped up during the course of 2017 came largely from Gaucho Quay and Orapa, both mines that have a lower average value per carat than the rest of our portfolio.